Hey guys, how's it going? It's Andy from MagooInvesting. Happy Wednesday. In today's video, I wanted to talk about a question that I've been getting a lot on these videos, and not on that last video. The stuff that I've been seeing on my last video where I talked about Bitcoin, I went to bed, I woke up in the morning, I like looking at the analytics because it kind of shows how well people are receiving my videos. And so I normally check to see what the average watch time was. And for the last video where I talked about Bitcoin and indicators, it was really low. And I was like, okay, that kind of makes sense. People don't really feel the same way about Bitcoin that I do. But then I looked and it had 150 comments, which is pretty ridiculous for my channel at this point. And then I went and I looked and I had been invaded by Russian bots. So kind of learned my lesson from that. I will not be talking about Bitcoin as the title of a video anytime soon because I've seen the amount of bots that'll come through and just ruin your comment section. So if you commented on that video and I haven't responded, that's why. I didn't feel like sorting through all of the Russian comments to find the actual real ones. So I'm sorry about that. Bitcoin is an important part of my portfolio, so I'll continue to talk about it in the future, but I just won't dedicate a video to talking about the topic. But in today's video, a common question that I've been seeing a lot on Reddit, Facebook pages, stuff like that is now the time to buy? And I've been seeing that a lot. We've had a lot of volatile weeks at this point. Yesterday, the market was up 5%. Today, it's down around 8%. And there's just a lot of movement in the market. And there's a lot of people that are trying to take advantage of these massive drops in the market, which I think is a really good idea. In past videos, I've talked about the importance of buying during really down times in the market because this is where you get fantastic opportunities to buy companies that you care about at a really nice discount. However, I'm going to lay out some opinions that I have about the overall stock market right now. We're going to look back at some of the other bear markets that we've had in the history of the stock market and kind of talk about where I expect the market to go. Before we get started, I'm going to change up the disclaimer that I make. And all the videos talk about how I'm not a licensed financial advisor and you should do your own research and talk to a professional before making a decision. But in this video, I'm going to come out with some very strong opinions. These are opinions that are coming from myself. You should not use them in your own decision making. These are just the opinions that I have. So at the point of making this video, the S&P 500 is down 30% since its highs. And this is just in about a month and a half. So this has been a really quick decline. And so I wanted to kind of put this 30% decline into perspective by looking at a lot of the other bear markets that we've seen since the 1900s. Obviously, when people think about stock market crashes and stuff like that, they think of the Great Depression and the stock crash of 1929. This is where we have Black Monday, the first history of that, Black Tuesday. Obviously, when you have the Great Depression, you're expecting the bear market's going to go on for a long time. So the overall bear market was 34 months, which is a really long time, and the S&P 500 lost 86% of its value during that time. This is one of the largest drops in stock market history, as well as one of the longer bear markets that we've ever seen. So this is kind of the baseline when people think of the worst case scenario. Don't think it's going to get anywhere near that, but I thought I'd talk about that because when people think of stock market crashes, they think of Black Monday and Black Tuesday of 1929. In 1961, you had a lot of world tension. You had the Cuban Missile Crisis, you had the Bay of Pigs incident, and during that time, the S&P 500 lost 28% of its value over 6 months. So this was a relatively short bear market brought upon by world conflicts and a lot of uncertainty about where the world was going. So it was a very short bear market, but it fell 28%, which is interesting because we've already fallen 30% in just over a month, which is kind of put things into perspective on how quickly things have gone down. 1968, the stock market fell 36% in 18 months as a result of a lot of unrest in the United States, whether it be with riots, participation in Vietnam, stuff like that. People were not very happy, and that turmoil in the United States pushed the stock market down into a bear market. In 1980, there was a term that I was doing research for this video that it popped up, and I just thought it was really funny. It's called stagflation. Basically, the idea is that there's really high interest rates and slowing of the GDP of a country. So you have the stagnation, and inflation. And I just thought it was a really interesting term, and I thought I'd bring that up. And during that time, the S&P 500 lost 28% over 21 months. So when you put it in perspective to the other bear markets that we've talked about and what we're seeing right now, it wasn't that extreme. I just wanted to bring it up because I think stagflation is a really funny word to kind of describe the overall state of an economy. In 1987, this is when people think about one of the other big Black Mondays. This is where the stock market dropped 23% in one day. However, when you look at the overall bear market that resulted from that, it was relatively short-lived. By the end of it, the stock market fell 34% in only 3 months. So most of the damage was done on that first day for Black Monday, where it fell 23%. And then the rest of the months, it was pretty stable compared to what we're seeing right now. When you see that the stock market fell 23% and then there was 10% left to go over the course of 3 months, that's not very volatile. The fact that we've been seeing 10% moves on a regular basis in the past couple weeks shows how ridiculous this volatility is right now. And then the last two are the ones I'm going to focus on for this video because they are the most recent examples of bear markets. The first one is the dot-com bubble bursting, and during that time the S&P 500 lost 78% of its value over 30 months. And so I'm going to talk about why 78% is really high and doesn't really reflect how things went, but when you look at 78%, that's a ridiculous drop. Then you have the financial crisis that went from 2007 to 2009. That was a 56% drop in 17 months. This is the first example of a bear market that I actually remember being a part of. I was only in middle school, so it didn't really affect me that much, but I just remember the overall panic that people felt. Parents were losing jobs. That's something I vividly remember from my time in middle school. Friends' parents were being laid off, and there was just a general sense of tension, even as a middle schooler. So those are the most recent examples, and I'm going to talk about where I think the market is going to end up during the course of this bear market. As I mentioned, we're down 30% already, and it's only been around a month. So based off of the prior historical data that we can see from these bear markets, I'm going to give my bold predictions on where I think the stock market's going to go. As I mentioned, these are my own opinions, and it's just one guy's opinion that you're listening to on the internet, so don't take this as being, I'm predicting the future. This is just where I realistically think the stock market's going to go in the upcoming months as coronavirus continues to play out on the world and the impact on the world economy is finally felt. My current prediction for where I think the stock market's going to go is I expect the S&P 500 to fall somewhere between the financial crisis of 2007 and the dot-com bubble bursting. And the reason I think that is I think the dot-com bubble bursting will never have that sort of drop again. The reason behind that is prior to the dot-com bubble bursting, you had the dot-com explosion. You have all these tech companies that were starting to come onto the scene, and venture capital was pouring into these companies, and these stocks rose a lot. From 1995 to 2000, the S&P 500 went up 400%, which is ridiculous to think about. So you have this overextending of the market. A lot of these companies went under, and as the stock market fell 78%, it went back down to somewhere that you could have found the price of the S&P 500 during 1998. So it was a big drop, but when you see 400% leading up to that, it makes sense why they describe it as being a bubble bursting. Things were getting really out of control. You had a lot of companies that were receiving funding and being on the stock market that didn't deserve to be there. The stocks went down, companies went out of business, and then we went through a pretty stable time up until the financial crisis. And that's why I have the dot-com bubble bursting at 78% down as being pretty unrealistic for what we're seeing right now. Based off of the 400% lead up to that moment, kind of the changing of the information age with technology companies coming in, I don't think we're going to see anything near that. While we haven't seen 400% in 5 years, this is the longest bull market that we've ever seen in the history of the stock market. So you have to kind of take that into account. And you have 11 plus years of incredible returns. We had a 30% year last year, we had a 30% year in 2013, and we had a couple 20% years during the course of this bull market. So while we're not as overextended as the 400% that I mentioned from 1995 to 2000, we went up pretty far in a long time. And so as we're coming out of this bull market, it's kind of makes a lot of sense why we're seeing this very rapid decrease in stock prices, because we had an incredible 2019, and now as the tension, the uncertainty comes into the market, it makes sense why the markets are shedding off some of those prices. But I do think that it might be potentially worse than the financial crisis of 2007, 2009. And the reason behind that is during that time, it was mainly focused in the United States, but it definitely had worldwide impacts because the United States was a huge player. But right now we're seeing unprecedented levels of shutdowns in the world economy. And so a lot of the worries that people have had in the past about the slowing of the world economy are being realized in an extreme way. Instead of the realization that maybe some companies' economies are slowing down, we're having a complete shutdown of pretty much the entire world's economy. And at this point, we really don't know what the overall damage is going to be. Based off of how volatile the market's been, people are trying to price in a lot of speculation. We just don't know what the overall impact of coronavirus is going to be on the world economy, specific companies' GDP, and how it's going to impact some of these very susceptible companies. We've seen a lot of news recently about Trump is going to come out and bail out a lot of these airline companies, and that's kind of protecting them. But at this point, I'm expecting to see a decent amount of companies go under. A lot of these small businesses that you have in your local communities are really struggling because they don't have the financial backing of some of these major corporations to survive through this tough time. There were some predictions this morning that I saw that US GDP could drop by 13% in this next quarter, which is a very startling number. And if that's the case, we're going to be in for a rough time. At this point, we just really don't know. There's a lot of speculation and a lot of uncertainty. And that's why the volatility is so high. So at this point, my prediction is that we're going to see between a 50 and a 60% drop. I don't know how long it's going to be, but at this point, we've dropped 30% in just over a month. And so I'm expecting some very volatile times to come. Okay, now that I've kind of set the stage for what we're feeling right now, I'm going to go back to the question that a lot of people have been asking. Is now the time to buy? And the answer is kind of. I know that's kind of a cop-out, but this is definitely not the bottom. If you look at this, the news stories that are going around, just kind of how everything's working right now, I think it'd be completely unrealistic to call this a bottom. We're nowhere near the bottom. There's so much stuff that we don't know. However, we are down 30% from its highs. And so this is definitely a decent buying opportunity. This is not something where I would go in and make massive purchases and try to maybe double up on some of the companies I already owned. If you've seen my portfolio videos, a lot of the companies that I own are very volatile. Stuff like Snapchat, Twitter, Bitcoin, those stuff are too volatile right now, and I'm not going to be taking any positions on them until the market stability kind of increases a little bit and we can see some upward movement in the market. So at this point, those are just going to be tanking with the rest of the market. However, there are two companies in my portfolio that I would consider adding to, and those are Activision and PayPal. These are two relatively stable companies. I think PayPal and Activision are going to do decently well during this tough time because payments between people are probably going to be lower than before, but they're probably not going to drop as much as some of these other industries are seeing. And then Activision focuses on video games. Their esports aspect, which is the thing that I like the most about them, has been pretty much shut down, but their main focus of their business is still doing pretty well. So those are the two companies I would consider adding to. For people that are asking if they should start adding to their positions, I would say very slowly. If you have cash set aside, I would say that it'd be a good idea to start adding to some positions if you think of them as being relatively stable. However, you do not want to be doubling down on your position. Say I own 100 shares of Snapchat right now, which I definitely don't. I would not go out tomorrow and buy 100 more shares because while it's going to lower your average cost, which is a topic that I'm going to have to talk about pretty soon, which is dollar cost averaging, that just means that you are opening yourself up to more downside. This is nowhere near the bottom, and picking volatile stocks is a tough decision to make right now. In a future video, I plan to make a video talking about dollar cost averaging because this is very applicable right now. And the last time I made that video, I had about 10 people watching my videos. So things have changed since then. The market has changed and my channel has changed a lot. In addition, I kind of want to make a video talking about where I would invest $1,000 right now because there's a lot of people that have not been in the stock market and have kind of been waiting on the side. And I've had a bunch of friends reach out to me asking if I was going to invest right now, what should I do? And so I'm going to make a theoretical, if I was starting out in the stock market right now with $1,000, where I would put it. But we're not to that point yet. So for the overall idea of this video, is now the time to buy a little bit. This is not the time to go big. This is time to start slowly adding to your positions as the stock market continues to fall. Once you start seeing some stability, you see the overall damage that coronavirus has done to the world economy, that's when you start making bigger purchases because now you can start to see the entire picture of what's happening. At this point, we just don't know enough. In my last video on Bitcoin, I talked about a way to determine overall market volatility, and that's by looking at the VIX, the VIX. It's a way that it determines or quantifies the overall volatility in the market by looking at the volatility of option prices for the S&P 500. That's including calls and puts. And so as the market volatility increases, the spread on the calls and puts increases because there's a lot more movement in the market. And so when I put up the chart for how things have been looking for the VIX recently, yeah, you can see how crazy things have been. This is at a historic level that we haven't seen in the past decade. So this is a crazy time to be in the market. It's a great time to be learning as much as you can to take advantage of it when things do start to settle down. These 8% moves in the market are not going to happen forever. We're going to go back to having 0.5% days or 1% days. And I'm kind of excited for that. But right now, there's a lot going on and it's a crazy time. So hopefully you guys stay safe out there and you're starting to make a plan for how you're going to take advantage of these incredible discounts on the stock market. Now is not the time, but you have to start planning. I'm starting to making some watch lists for what I'm looking to target in the future, but still have a long ways to go. So hopefully everyone is having a decent time in quarantine. I'm starting to go a little stir crazy after a couple days, but making videos definitely makes things easier. So thanks for watching, and I'll see you in the next episode.